Good evening, everybody. This welcome to this corporate webinar. This time, we are doing this now fourth time, and everybody is so excited for this corporate tax which is being introduced next year, and it is just round the corner now. We have very expert panelists with us. Viva Madam and Shyamji are with us, who will give us more information about these insights. And Viva Madam does not need any introduction. So many times you have introduced this chartered accountant with over 10 years of experience, and she's the exact person to tell you everything about this aspect, clarify all the doubts. We'll have a Q&A session also subsequently as the webinar folds up. So, Vibhaji, you are most welcome to start it, and the stage is all yours now.
Good evening, everyone, once again. And thank you, and Rajesh ji and Shyam sir for the nice introduction. Let's begin with our fourth webinar as we are discussing the upcoming corporate tax, their implications on the existing compliances. And now this time we have the recent amendment in the VATs also. So in VAT, the amendment are few amendments are very major, but the other amendments are the confirmation of what we are doing into the practice because of the language change. They changed little bit language, and it's a kind of confirmation that what we are doing is going in the correct direction. But there are few major amendments which need to be checked, that okay, how they are going to implement in your business. So today that is the additional thing when it comes to the tax. We will start with the basic corporate tax first, because every time we are coming up with the request that someone missed last time. So we are covering the few basic slides of corporate tax which we discussed in the previous webinar also, and with that we will emphasize on the VAT amendments, recent VAT amendments which was there in the last week. So this is about our company, Horizon-based consultancy. We are 60-year-old in consulting, either it is taxation, finance, and any other consultancy and allied services. Delphi Star, you all know, is a reputed educational training institute in Dubai, providing training in accounting, taxation, finance, and auditing, and many more finance-related courses. Coming to our topic, corporate tax. We all know corporate tax is a direct tax which is going to impact directly on your business profits. In UAE, the direct tax is only on the business profits. They are not coming up with the personal income tax, and it is going to be applicable from June 2023. So if I'm talking about June 2023, the applicability of the corporate tax will be depend on your business financial year. So if you are following the January to December financial year, then corporate tax is going to implement on your business in January 2024 to December 2024. So this is one of the very important thing you need to know about the applicability of corporate tax. It depends on the financial year of your business. And let's take the second example. If your business financial year is April to March, then applicability of corporate tax on your business will be from April 2024 to March 2025. So this depends on what financial year your business is following. Though in UAE it will be applicable from June 2023. So after June 2023, whenever your financial year will start, the corporate tax will be apply on your business accordingly. So this is about the corporate tax applicability. It is going to be the 99% on your net profit. Who is going to cover under the corporate tax? First of all the natural persons like you, me, all are covered under the corporate tax. We will go in the detail how you will cover in the corporate tax, because I mentioned it is going to be the corporate tax. It is not a personal income tax. UAE is coming up with corporate tax, not the personal income tax. Then any legal person, any partnership, any LLP, company, any form of legal person covered under corporate tax. Any person having permanent establishment in UAE, including natural or legal person outside UAE, is also going to be covered under corporate tax. So PE is what is PE as per the consultation document issued by FTA that we will take in this session later, that what is permanent establishment, which is going to covered under corporate tax. So it is more like if you're a foreign company and still you have a structure in Dubai, then, or I will say UAE, then you are also covered under the corporate income tax. Other than any person who is not exempt is also going to cover under this corporate tax. Then coming back to the first one, natural person is covered, but only when if he or she is involved in any business. So if you are involved in any activity which require licensing, then you will be covered under the corporate tax. So natural person, salaried person is not going to cover under corporate tax. If you have a small real estate investments and you are earning rent income on that, capital gain income is there, but there is no license required to perform that activity, either to having a property, give it on rent. There is no licensing required as per the Companies Act of UAE to have a license for that activity. Then you are not covered under corporate tax for that activity. But for example, you are into any trading business or any other business which require license as per the Companies Act, then you are going to cover under the corporate tax. Though you are not a legal person, you are a natural person also. So ultimately it is only on the businesses. If it is in the name of a natural person, that is also going to cover. If it is in the name of any legal structure, that is also going to cover. Any permanent establishment in UAE, that is covered under corporate tax, other than any exempt person. So what are the exempt person as per the consultation document is business in extraction and exploitation of natural resources, because this is already covered under the Emirates tax. All Emirates have the tax on the extraction and exploitation of natural resources. So this is not going to cover under the corporate tax. Charities and any other public benefit organization is not going to under this act. Investments funds, public and regulated private social security and retirement pension funds, they are also exempt under this corporate tax. So other than these one, whichever is left and they have a license and involved in any business activity, they are going to cover into the corporate tax. Moving forward, how to calculate the corporate tax? What is the basic limit? So the basic limit is $100,000, which is $375,000. If your taxable income, that is the net profit of your business, will be less than $375,000, the liability to pay corporate tax will be zero. If your business is more than that, then the corporate tax, you will come under the purview of corporate tax, and the liability of the same will be 9% on the profit which is more than 375,000. So this is how you need to calculate your corporate tax liability. If you have any foreign tax credit also, so if you have paid any foreign tax on the same income on which you are paying tax in Dubai, in UAE, that credit also you can take, and whatever will be the left, you can pay the same. How to take the credit, what are the criteria to take that credit, how you will calculate that credit, that we will cover in the later stage. Up to some extent it is available with us, because the full law is still not out on the corporate tax, but the framework of the law is there. So there is a consultation document on the basis of which we are preparing this webinar and presenting you. It's only on the basis of consultation document, which is the basis of law. So the minor things, the how to calculate, and there are many other provisions which need to be there. If I'm talking about the net profit, the net profit is not going to be as per your P&L. There are many adjustments you need to do in the net profit to calculate which is apt for to calculate the corporate tax. So those are the many things are pending from the FTA side that we are awaiting. But the framework of law is there, which helps you to structure your business, how it should be, whether it should be in free zone, whether it should be outside, whether it should be in Dubai. And then you can also assess and prepare your books of accounts accordingly, that how you will prepare for your corporate tax. Then coming up to what are the compliances and required under this compliance thing. First, you need to have a registration and deregistration in the same way you have in VAT. So the way you have a identified dedicated number for VAT registration number, the same way you will have a registration number for corporate tax. So registration is going to be compulsory for every business. Then once you are the registered, then there will be the annual tax return which you need to be filed within the 9 months of the end of that financial year. So for example, as I mentioned in my first slide, you are following January to December financial year, and applicability of corporate tax will be on your business from January 2024 to December 2024. Then you need to file the return of your first corporate tax return within the 9 months from the December 2024. So this is about the tax returns which you need to file by yourself. Like FT will not come to you. You need to prepare by yourself on the basis of your books of accounts, and you need to file. So that's why it is called self-assessed tax. So the payment of tax and filing of return will be self-assessed. You need to assess this thing by yourself. Then auditing of your books is going to compulsory once the corporate tax will be there. This is also one of the framework. I will say, you need to be ready to get your books of accounts audited if you are not currently into that. So first of all, before auditing, you need to comply the books of accounts as per the IFRS. You need to prepare the books of accounts accordingly so that they can get audited. Maintenance of books of accounts is an implied requirement. If you need the audited books of accounts, then the maintenance of books of accounts also you need to do. Going further, the most important topic, or I will say the most the question which we are getting from our client is, or from the network, is whether free zones are also going to be covered under corporate tax or not. So this answer is not straightforward, we'll say. It's not like yes or no. There are many things which you need to consider before deciding this thing, that whether they are going to cover, which free zone is going to cover under corporate tax or not. So rather than free zone, it depends on the business, I will say. They decide that you are going to cover under corporate tax or not. So I try to simplify this thing, that which free zone will cover. In terms of the cases, I have designed this thing in case to case basis. Maybe this will clarify you this, that how free zones are going to cover under corporate tax. So we'll go to the free zone 1, case 1, in which the free zone A is supplying goods to free zone B. So supplying goods or services, whatever it is, it's mean like dealing with free zone B. So if one free zone is dealing with another free zone, there is no link of mainland, then the corporate tax will be 0%. So it's not like that the income is exempt, the applicability is not there. It is there, but it is 0%. So what does that mean? That means that there will not be any liability to pay 9%, but the reporting part will be there. You need to file the returns, you need to report the things. But yeah, there will not be any liability to pay the corporate tax. It will be the 0%. Case 2 is if free zone company is giving any is transacting with designated zone company, then also it is 0. So what is the difference between designated zone and free zone? Nothing, if we are talking in normal layman language. But if we are considering the VAT perspective, then in VAT there are the defined free zones which are considered as a designated zone. That's why this term came up, and we know that there is a concept of designated zone also. So don't get confused with free zone and designated zone when it comes to the corporate tax. Until I will say now, we don't have any clarity that there is a defined designated zone under corporate tax also. So if you are dealing any free zone and any designated zone within themselves, or within the same free zone, there will not be any liability if you are only fully involved with this kind of transactions. Going forward with the case number 3, if any free zone A is dealing with the branch of its which is in mainland, the free zone company having a branch in a mainland company, and they are transacting with each other, and the transaction between the transfer of goods between them is the importer on record of the mainland company, then there will not be there will be zero corporate tax on that transaction. But the mainland company will not get the deduction of those purchase expenses which is done on their import code from their from the free zone. So ultimately this part of expense, or I will say the purchases, is going to be taxable in the hands of the mainland company, though it is a income of a free zone company, because you will not get the deduction of this purchase expense in your mainland branch company if you are importing on the import code of a mainland company. But if you are doing the same in the free zone company, which is the case number 4, if you are transferring the goods to the mainland and the importer on record is free zone, then the chargeability of corporate tax will be 9%. So then you have to pay 9% corporate, that this free zone company will cover under the corporate tax purview of 9%. So here, if you're dealing with a mainland company, depends how you are transferring the goods, whose import code you are using, whether it is free zone company or mainland company. If it is free zone company, then the free zone company will cover under the 9% purview. If it is mainland company, you can get the free zone company can get the exemption of 0%, but the mainland company will not get the deduction of those expenses which is coming from a free zone company, and the free zone companies are willing the benefit of 0% taxation. So this is as per the framework is as per the consultation document, though we are awaiting the more clarity in terms of that, but it will not be kind of full change. It will be 5 to 10% here and there, the minor changes will be there. The framework of the things is going to be the same, which is the expectation. Coming forward to the next case, which is case number 5, if a free zone company is dealing with a mainland company, and mainland company is an importer of record, so whether it is a branch of a free zone company which is in mainland company, or it is any other company with whom the free zone company is dealing, then also the 0% benefit free zone company can take. But the mainland company cannot take those expenses or purchases as a deduction while calculating their profit for corporate tax. Case number 6, if any free zone company is dealing outside UAE, there is no connection in any free zone, any mainland, everything is exported from a free zone, then straightforward, the taxability of free zone under that case will be 0%. Taxability of free zone when it comes to the passive income from mainland in terms of dividend, royalty, any capital gain to free zone, then also it is considered as a 0%. It will not be chargeable 9%. So here now the structuring, why they have issued this thing, and why it is important to know about the taxability of free zone, because many companies based in free zone on mainland, they are doing mainly 90% of their is only exports, they have only 10% local business. So rather than doing 100% business from the company which have the chances to cover under corporate tax, they can bifurcate their sales in that way, that if they are mainly with exports, so better to have a structure in the free zone and export from there, rather than having a mainland structure and export there from there, and locally also they are supplying from there and paying 9% on the full profit. So if the free zone company is exporting fully outside UAE, then they will not cover under the purview of 9%. So this is the example I'm giving you. There are many other kinds of structure and different clients are having. They need to think about their structure, so whether they are covering it or not covering it, they need to decide on this basis. It's not like they're just opening a free zone company can resolve the problem. There are many structural changes or things you need to consider before going into any decision, whether to have a mainland company or free zone company, and which kind of operation from that need to be done to avail the benefit of 0% to make the tax planning of the things. So this is about the free zone. What are the compliances you need to do in a free zone is whether you are covering in the scope of corporate tax. Free zones, yes, free zone covered under the corporate tax. Filing of corporate tax return is also compulsory under free zone. Audited financial statements are also covered under free zone. And free zone have an option that even though the FTA have given the exemption to them, but they have an option, they can go for a 9% taxation also. It depends on their choice, or they can go for a 0% exemption also. But whatever option they will select, it is going to be the compulsory. Once they select that, then it is irrevocable. So you need to be very conscious when you are opting for any exemption, or when you are opting for 9%. Going forward about the tax groups, this is about the free zones. So when we are talking about the tax group, we are aware about the VAT tax group, how in VAT they have defined the tax groups, and what are the benefit of having a tax group, and what are the disadvantage also to have a tax group. So they also come up with the same kind of concept in corporate tax also. In corporate tax regime, you can have a tax group. There are the criteria which you need to make made first, then only you can form a tax group under corporate tax regime. All the companies should be UAE companies if you want to form a tax group. The parent company to hold a minimum 90% of the share capital or voting rights of a subsidiary, then they can form a tax group. The parent company or any of the subsidiary should not be an exempt person or a free zone person that taking the benefit of 0% corporate tax. All should cover under the 9% tax regime. Then only you can be a part of a tax group. And all the group members adopt the same financial year. That is also very one of the important condition, because it is not going to be the monthly, it is not going to be the quarterly, it is going to be the annually. So the financial year of all the companies who want to be a part of a tax group, they should follow the same financial year. So these are the criteria which need to be fulfilled. Maybe they will come up with a detailed criteria list when we are talking about the voting rights of the subsidiary and 95% share capital, how they will take that thing. But yeah, the tax group, we all know tax group have the benefit if you have a number of companies. So rather than going for different companies, different paying liabilities, tax liabilities, different filing of returns, rather than form a group and do single one, it just you have to do calculation within yourself. And then again, if one company is making profit, another company is making loss, then also you can adjust up to some extent that thing. And if you are a tax group, if you are not a tax group, then also they have provide this facility, but there is a limitation on that. But if you are a tax group, you can form a tax group, then you can adjust 100% your profit, 100% your loss with the profit making company, and you can reduce your liability rather than not paying tax on the loss making company and take it forward. And for the profit making company, you need to pay the tax more if you are not adjusting to the loss. So this kind of adjustments are more helpful when it comes to the tax group under the corporate tax regime, rather than in VAT. VAT liabilities, in VAT, majorly the benefits are doing compliance for one company rather than for different companies. Yeah, intercompanies taxation is not there, VAT is not there if you're a tax group company. In the same way, corporate regime also have a good number of benefit to have a tax group, and one of the major is adjustment of your loss to the profit making company is the major one. Going forward with the same line, if you're not a group or tax group, then also you can transfer your losses to the group companies even though you're not registered as a group under FTA. So how you can do that? There are the conditions for the same. Group companies are at least 75% commonly owned, then only you can transfer the losses between the group companies. No transfer allowed for exempt and free zone companies. All the companies should come under the purview of 9% taxation. Tax loss not to exceed 75% of the taxable income of the receiving company. So if one company is having the profit of 100 and you are adjusting the loss of any company towards that, then only you have a 75% of that profit which you can adjust. On 25% you need to pay tax anyhow, even though you have a more loss. So if the loss is still there, you can carry forward it. That is another scenario, but for that we don't have any clarification yet that whether you can carry forward your losses or not, and if yes, for how many years you can do. But yeah, in generally direct taxation, these kind of provisions are there that they will give you the carry forward of loss which you can adjust in your upcoming profits in the upcoming years. So if you are not a tax group, still you can have a transfer of losses between the group of companies if they have the common shareholding of 75%. Now come to the taxability of the foreign companies. As I mentioned in the first slide of the presentation, that if you have a permanent establishment in UAE, then also you are covered under the corporate tax regime. So foreign companies are considered as a resident if they are effectively managed and controlled in UAE. So what is considered as a effectively managed and controlled in UAE is if they have described a P test, which is permanent establishment test. So what they have done, if you perform that test in your business and you are successfully complied that, then you are covered under as a foreign company, considered as a resident being a foreign company itself, and you're covered under the corporate tax. So what is this PE tax? The purpose of this test is to determine if and when a company has established sufficient presence in the foreign country to warrant the direct taxation of the business profit in that country. So that is the purpose to perform this test. There are two kind of tests they have illustrated. First is fixed place of business test, and second is dependent agent tax. So what is this fixed place of business test? Under the fixed place of business test, if a place of management, an office, a factory, a real estate property, or a building site where activities are carried on for over 6 months, preparatory or auxiliary activities are not included. So if any business who have the fixed place of management or office or a factory or any real estate property or building site where the activities are carried for more than 6 months, then it is considered as that business have a fixed place of business in UAE, and that is covered under the corporate tax. If I can see, I think few participants are raising hands. What I can advise you guys, it would be great if you can note it down your questions, because we will take the questions in the end, not during the session. I know you many have doubts, but there are many doubts which will be clear in the upcoming slides. So that's why we always take the questions in the end. So we will surely come back to your questions, but just keep patience and note it down with you with those. We will take them in the end. So if any business is having this fixed place of management or any office where they worked for more than 6 months, then that foreign company is considered as a resident company and covered under the corporate tax. Either that even that company paid any tax outside UAE, that you can take a credit, foreign tax credit, which I mentioned in my previous slide, and we will have one slide on that in the upcoming presentation also. You can take the credit of the same company, but that is going to be taxable here. And like, let me just tell you and clarify here, 9% tax is the minimum tax you can find overall, like anywhere in the world. If you will compare, then hardly few countries have this minimal tax 9%. So anywhere you are paying tax is more than 9%, and if you will claim that foreign tax, then there will be hardly any liability when it comes to the payment of tax. But yeah, the reporting will be come into the picture. So ultimately government will get to know that how much foreign company is transacting with this part of world. So this is the main purpose to get this regulation in place also. So you are going to cover under the corporate tax, but you can get the foreign tax credit if you have any on the same income you have paid outside UAE. Any populationary or auxiliary activities are not included under this. So if you're doing only main business, then only you will cover under this test. If you're only doing, the any research kind of activity or any auxiliary activity, which is not the main part of your business, even though you are doing that activity for more than 6 months, you are not going to cover under PE, and you are not considered as a resident under this corporate tax regime. So what are those activity, whether it will cover or not, that it depends on your business, and there is a proper information and tests need to be performed, then you will get to know. So this is one of the tests about the fixed place. The second is dependent agent test. What is dependent agent tax? A person, a UAE based person, concludes contracts and acts on behalf of foreign company in UAE. Not counted if the same is done in ordinary course of business by an agent. So if any person who have the authority to conclude the contracts and act on behalf of a foreign company, then it seems like that the company, the person who is based in UAE have a control over the things and have a decision making power. So if you are covering under that criteria, then it is considered that company is considered as a resident in UAE and come under the corporate tax regime. But if any agent is doing, if there is a outsourcing agent whose main business is only doing this task and they are doing on behalf of any company, then it is not considered as a dependent agent test. If there is a specific person dedicated to that company and doing all these things on behalf of foreign company, then only they are considered, and you will say the pass the dependent agent test, and they are considered as a resident of UAE. UAE sourced income earned by the foreign person that does not have a PE in the UAE will be subject to withholding tax at the rate of 0%. So if you are not covered under the any of the test and you are not resident, but you are earning income from UAE, the source of income is UAE, then also there is a tax which is called withholding tax, and the rate of that withholding tax is 0%, which is mainly kind of you need to report that how much that foreign person sourced income from the UAE. So that's why there is a 0% withholding tax on that. So the reporting part of that will be there. So this is mainly regarding the foreign company taxability. Going forward to the foreign tax credit, as I mentioned that there is a concept of foreign tax credit. Whatever tax you have paid on the same income which you are liable to pay here in UAE, that you can take as a credit. Tax credit allowed for foreign sourced income to avoid double taxation. Maximum credit you can take is tax paid in the foreign jurisdiction or the UAE company, UAE corporate tax payable on the foreign sourced income. So any income if you are a foreign company and you are considered as a resident in UAE, that means your full income is going to be taxable in UAE. But you must have, even though that is a foreign sourced income, but you must have paid any income tax, any corporate tax in that country where actually it is sourced. You can take the credit of that one, and that credit maximum you can take either, for example, you have a company A is in India and the company is having the permanent establishment in UAE also. The company become the resident of UAE because of the permanent establishment test. Then the whatever the income company A is sourcing from UAE, that is going to be taxable anyhow at the with the withholding tax. But if the company the income which the company is having from India, that is also going to be taxable in UAE, but you can take the foreign tax credit of the tax paid by company A in India. So anyhow, the Indian corporate tax is around 25% to 30%. So whatever you have paid there, you can take the credit here, and here it is only 9%. So there will not be any liability to pay corporate tax on your foreign sourced income, but there has to be reporting. You need to take the credit and then you will pass through the reporting part. Carry forward not allowed for unutilized credit. So as I mentioned in my example, that the in India, that for example 25% is tax you have paid on that foreign source income, and in the UAE it is going to be 9%. So whatever the balance is there, 16%, you cannot carry forward that 16% foreign tax in the next year. It is only for the same financial year you can carry forward. So this is about the foreign tax credit. I think major clarity you will get when actually it will come in the picture with more regulations. So this is a very well structured they have done the corporate tax. There will be very less burden. It is not like that even you are sitting here and you are earning income from anywhere and they are going to charge 9% on that. It's not like that. They just need the what you are doing kind of information, how much income you are making, how much tax you are paying outside, because this whole implementation of corporate tax is because of IMF, and they have the exchange of, now most of the countries have a agreement to have exchange of information, and they want to reconcile these information, because to avoid the anti-money laundering and all these things. And now we maybe in future we will come up with within a timeline of 5 years this minimum tax. So every country who is following BAPS or who is covering under that, they are going to follow that thing. So that's why the to be a tax regime is one of the important requirement for UAE at this moment. So this will be there, but the burden of the tax is not going to be that much if we compare to the other countries. So this is about the foreign taxes. If we are talking about the correlation between VAT and corporate tax, this is very important. You need to know whatever you are reporting, whatever you are assessing in your VAT, it should be reconciled with your corporate tax, because the authority is same, FTA. They can reconcile the things within their within their part. So you cannot say that in VAT my sale is this and in corporate tax my sales are this, even though when it comes to the expenses and other things. So I try to catch the points which can you need to be reconciled mainly. VAT is mainly associated with sales and purchases or expenses, which is the output tax and input credit tax, whereas corporate tax is about the net profit. Reconciliation of VAT and corporate tax is a very important aspect, as the allowable expenses under VAT might not be same as per the corporate tax. There are few expenses if you will see that is not allowed under VAT, like entertainment expenses or other expenses, which is you cannot take the credit on the same. But when it will come to the corporate tax, the limitation and the percentage of things will be different. It's not going to be the same. So you need to know that what is in the both, and there has to be a reconciliation and common things which you are following. For example, entertainment tax. So in corporate tax it is 50% allowed, in VAT, the input tax credit on corporate tax is not allowed. So if you are disallowing and you're reporting that we're disallowing the entertainment expenses this much, then you need to know when you are claiming entertainment expenses in your corporate tax return, it should be reconciled with each other. You cannot say one side it is 100 and one side it is 200. You got my point. In the same way, input tax credit, whatever in your returns, you need to have that in your P&L. Directors remuneration, you cannot say that we are going to take the directors remuneration of as much as on the basis of your profit to minimize your corporate tax, this 9% thing. But and at the same time, if you will go in the VAT, if any director is having more than 375,000 directors remuneration, then they also covered under the VAT. So before planning anything, you need to think in that way also, that what will be the impact from the VAT perspective if you're talking about the corporate tax planning. Reverse charge is there. If you are showing that we imported something, that there has to be reverse charge reporting when it comes to the VAT returns. And now in the recent amendments of VAT itself, they have emphasized a lot about the reverse charge thing. They are very serious. If you are not reporting your reverse charge liabilities, then please do it. Otherwise, there will be the huge penalty and impact on your business of that. Import of services, many business miss on this part, that they have import of services, but they hardly report that in their VAT returns. So that also you need to do. Capital expenses, if there is any capital expenses and you are taking the credit of the same as per the capital scheme, asset scheme in the VAT, then the depreciation should be reflected in the same way. The value of the asset should be in the same way in corporate tax and VAT. So there are many things you cannot, when both the things will be in the place. Now VAT is already there, when corporate tax will be there, then you will get to know you cannot play the things around. There has to be a single reporting, single thing going to the authority, then it is not the problem. Otherwise there will be the problem for you. Even not in VAT, if you are, there are many reportings nowadays. The ESR is there, the UBO is there, the AML is there. All should be reconciled, because everything is covered under one authority and they have a power to reconcile the thing. So whatever information you are providing at this point of time, be cautious about that. They can come up with the information you already provided to them. So this is one of the things which we need to think when we are talking about corporate tax. Then double taxation agreements are going to be much more into the fashion, because the corporate tax is there. UAE is a place where all around the world companies are here, many multinationals are here. So which income is going to be taxed where? The treaty of with those countries we need to go through, and then we need to assess that what is the taxability and where is the taxability of the same. So there are the double taxation treaties between two countries which define a dedicated kind of income in terms of dividend income, capital gain income, sometimes business profits. So every treaty is different. What kind of treaties are there and how to read them, that also we need to we need to actually learn, because these things are very new when it comes to UAE. So there are three models of double taxation treaties: OECD model, UN model, and US model. These are the three models which generally treaties have. Currently, UAE have more than treaty with more than 100 countries. So already UAE have lot of treaties, and we hope that it will come up with more treaties also, because that will help us to avoid the double taxation and provide more clarity to the taxpayer about their liabilities. So double taxation treaty is also going to be in picture when you are dealing with multinationalities, if you're working with multinationalities company. Then transfer pricing is one of the most important regulation which is going to take place in this part of world. And here it's not only international transfer pricing, domestic transfer pricing is going to hit more than the international one, I will say. because let me just first explain that what is the transfer pricing. Transfer pricing is the price of goods or services, intangible asset, or any transaction between two related parties is a transfer pricing. So if there are two related parties, what are the related parties? That definition we are awaiting officially from the FTA side, but it is more if there is a common beneficial interest of any party, they are considered as a related party majorly. And if there is any transaction between them in terms of transfer of goods, in terms of transfer of services, transfer of any intangible assets, any transaction I am talking about is happening between them, that should be as per the market price. It should not be the arrangement between these two related parties. This is a very layman language of transfer pricing. And if you're talking about UAE, the transfer pricing is not going to be between the related party uh, in UAE and outside UAE. It is going to be the domestic TP also. Like if you have a company in free zone and you have a company in mainland, then the transaction between those related parties who are based in free zone and mainland are going to covered under the transfer pricing. So you need to get ready with the transfer pricing regulations also, whether it is applicable on your business or not. If yes, then what kind of compliances you need to do. It's not that something you need to report annual basis, or you need to pay 9% on anything. You need to prepare proper documentation to have a record whatever the transaction you are doing between the related party, how legit they are, how the price which you are dealing with, what is the legitness of that price is what you need to prove to the authority when it comes to the as a question to you. So that is majorly comes under the transfer pricing regulation, but it is going to be the majorly impacted this part because here many related parties are working with each other. So that's why transfer pricing is also one of the major compliance which is coming up with the UAE corporate tax. Now let's come to the last part of our presentation, which are the recent VAT amendments. So these all amendments are going to be applicable from 1st January 2023. I have only summarized few important amendments, which is not just a language change and which is majorly will impact your day-to-day activity also. So first of them is they changed the time limit to issue a tax invoice, and they have introduced the time limit to issue the credit note also. So previously to issue the tax invoice is 14 days. Currently that is the same, but they have changed only if you are into the kind of activity which is a continuous activity. There is no limit to issue the tax invoice in that, but now they have put the limit on that if you are involved in any activity which is in the nature of continuous service or continuous, I will say, the transaction, then also you need to issue the invoice within 14 days of that continuous transactions. As well as they have put the limit for a credit note also. You have to issue, if there is a liability to issue the credit note, you have to issue the credit note within 14 days of the time limit. Registered person can also apply for certificate of exception. Certificate of exception is a certificate which you need to have if you are only involved in 100% zero rated supplies. And previously it was like that only the non-registered person can only apply for that certificate of exception. If you are only dealing with zero rated and you are a registered person as a normal, then there is you cannot do anything. If you are a new registrant, then only you can apply for certificate of exception. But now they come up with that if you are already a registered and you think that you are 100% involved in export of services, then you can apply for this certificate. Maybe FTA will give you the exception from VAT. They have introduced this thing that to claim the reverse charge mechanism, proper invoicing should be required and documentation should be required. They are very much emphasized. Other amendments are also related to reverse charge mechanism are quite well, and they are emphasizing on this part much, because reverse charge in many countries. If you guys are aware that people are first collecting the VAT and then they are giving the credit on the once they are satisfied that this is a claimable credit. But in UAE they have put this thing that you can claim the credit only without paying VAT. Just you have to report the same. So that's why whenever the audit will come, they have a depth checking of reverse charge mechanism every time. Whoever that whichever the transactions you have covered under the RCM, they will check in each and every transaction in and out and reason for the same. So don't miss on the documentation part of RCM. Then FTA have a right to audit up to 15 years in case of non-registration from the date on which the taxable person was required to get registration. If you are not a registered person, and FTA can come to you and audit the things up to 15 years from the date you are liable to register, even though you're not registered person. So FTA have right to ask the question any of the business based in UAE, though it is not registered or not. FT have right to audit 15 years in case of any tax evasion. If there is any tax evasion, then they can have audit up to 15 years. Voluntary disclosure cannot be filed after 5 years from the relevant financial year. So this is a very important change, I will say. Voluntary, they put the timeline that you cannot file the voluntary disclosure after completing the 5 years from the relevant financial years. So now the VAT is going to complete the 5 year. But if you're talking about the VD, then you cannot file the VD for the first year 2018 after December 2022, because 2017. So after that you cannot, once the 5 years are completed, you cannot file. So for the first year you cannot file the voluntary disclosure after December 2025. For the second year you can file the voluntary disclosure. So there is a limit, if you know that you have made a mistake and you file the voluntary disclosure, then the penalty will be less, but the chance will you lose once it completes the 5 years. So you need to check your first year of VAT. If there is any voluntary disclosure due, then better to file it before December 2022 rather than waiting, because after that you cannot file the same. So there is a limit on that. It's not like that the 5 years is completing and you will not file any of the year voluntary disclosure. It's only for the first year you cannot file now, because for the first year it's going to be the fifth year is 2022. Time extension for audit period by FTA is up to 9 years. So before it is like that up to 5 years FTA can audit your books of accounts, but they have put a new clause that if FTA issued a notice or any notice of the audit, then they have a timeline to complete that audit up to 4 years from the time they have issued the notice. So for example, if they have issued the notice before December 2022, they can audit you from the 2017 up to next 4 years. So they have opened the more windows for them when it comes to the audit part, but the condition is the notice should be before December 2022. So if you receive the notice before that, then it is unfortunate, and if you are not, then it's good for you. At least you cannot, for the first year you cannot cover under the FT audit. So this is about the recent changes in VAT. Other than that, we are open for any queries. Q&A we are taking now. I think we can take Shamji Q&A.
Definitely. And I'm just going to announce one more thing, Biva, that there are a very high demand now for the for the training for your corporate tax transfer pricing and your VAT amendments. Mm-hmm. So by end of this month, we are going to launch our combined training. Okay, so there are several people have shown the interest for the corporate training. So as we discussed that our training models are designed in such a way that transfer pricing is quite clear, so there is no ambiguity on that. VAT amendments are also quite clear, so there is no ambiguity on that. Especially for the corporate taxation, a lot of things have already been published, and some of the things are already under publication, so that government will clear it. And according to that, we'll also give the students some time to take the clarity from us. So just a information to everybody that with request of all our previous webinar participants, so by end of this month, we are going to start our combined training for corporate tax, transfer pricing, as well as your VAT amendments. Yeah.
I think that is a good one. This thing, because in that we can get into the details of the thing, because in
Yes.
webinar you can just give the glimpses. You
Yes.
cannot answer the all the Q&A, and there are again after the Q&A there are the clarity required actually.
Yes. So how to prepare the financials, books and all that, and how to, as per the corporate tax, how the compliance will be there. So detailed training will be provided on that, so that any layman who have never worked in the taxation environment, he should be able to work on the taxation environment. Because the people who are, let's say, even who are coming from the countries like India, Pakistan, Bangladesh, who have worked on the taxation zone, in spite of that staying in this country for a long time, who are away from the taxation rules or regulations. So our model for design in such a way that they also should be able to start from the scratch and able to work out. Yes.
Yeah.
Yeah.
So for Q&A, we have, I think, one raised hand of Afnas.
Yeah. So one question is there. Best books for VAE corporate tax and VAT and transfer pricing. So here, I believe, Mr. Asif, that there is nothing. I don't feel there is any book right now in the market for corporate tax, VAT, or transfer pricing. Because even if whatever information for available, that's scattered and very vast. So you have to compile all the information. So like for that, definitely two ways to do that one. Number one is that either you have to since you're a chartered accountant, you have to look for the scattered information from all the places, compile it and do your own. Okay. Or you can definitely come to us, which like Biva, who are having already 10 years working experience in the taxation, and she's a tax expert only. She's doing taxation for a long time. She's working on transfer pricing for a long time, and currently she's handling more than 150 clients. During this year only, she set up business. Her company has set up business for more than 150 clients from India in UAE itself. So taxation, transfer pricing, VAT, which is her regular job, and she has compiled everything. So definitely you have two choices. One, I know specific books are difficult to tell. Either you can compile all the information from all the places, scattered information, or you can definitely contact to the training provider like us. Yeah.
Yeah.
And one more question is there, Shyamji, from Mohammed.
Yeah, but his question is not clear. Can you give us example about, please, so that it's not very clear?
At that time, the webinar was going on, and in that.
If anybody has any question, please, ask, no problem. We are ready to answer that. Okay, so Afnas has some question. Okay. Right. Okay. I'll allow him to talk. Okay. Yeah. Please tell. Yes, Mr. Afnas, please.
Afnas, you are mute actually.
Actually, we have allowed you to talk. Please, you can either. Okay. I think he's posted some question. He's doing fantastic. So he's talking about Mr. Asif is talking about that he is looking for the training. Definitely, Mr. Asif, we'll get back to you soon, because we are just finalizing our models, because how because what happened, just going directly to the corporate tax doesn't make any sense. We also have to go step by step, so that especially in the UAE region, where even chartered accountants, even me, I'm also a chartered accountant for a long time, and I have not worked in the taxation environment for almost last 15 years. So based on that only, we are designing the course, and definitely we'll get back to you, sir. Okay, fine, no problem. We'll just share it with you, no issues, sir. Yeah. So any other questions? Any other questions for there? No. So I believe that Biva, your webinar was outstanding. So we got a lot of clarity about the corporate tax, even being a chartered accountant. I also had a lot of doubts. So you really did your homework fantastic, compiled all the scattered information from different places. Because right now, definitely, I also do consulting, training. Every company has a lot of confusion for the taxation. People keep on asking me whether applicable to free zone or not. This is applicable, that is applicable. So you did a fantastic job of compiling all the informations, and keep on sharing your knowledge through webinar. Okay, that's a really helpful to everybody, in even me as well. Okay.
Thank you, sir.
Yeah, I think there is one question. Okay, fine.
Thank you so much, Vibhaji and Shyamji, for a wonderful webinar. Every time, this is mesmerizing, and so much information is added to all of us, and all the participants are also glued together, till the fag end of the webinar. Thank you so much, everybody. Have a nice evening and a nice weekend ahead.
Thank you, Rajesh. Thank you, everyone. Have a nice evening. Thank you,
Thank you, sir.
Shyamji.
Thank you, everybody.